What's going on, guys, and welcome back to another video. So last night I was looking through my portfolios as I haven't invested over the last 2 or 3 weeks, and I was quite surprised with how much they've all went down, which is actually good as a long-term investor, especially that we only started those accounts only a few weeks back now. So it's going to be a brilliant opportunity to dollar cost average. Now, upon further review and research, the overall markets across the board, be it in growth, dividends, crypto, etc., are all fairly down, and there is a bit of a bear market on the horizon. So in today's video we're going to look over each of my portfolios, which are dividend, growth, ETFs and crypto, and we're going to discuss my plans going forward now that they're all in the red. So that being said, let's get straight on into today's video. Now, just before we get into my portfolios, it was asked quite a bit now in comment sections and prior videos what dollar cost averaging actually is. Now, in a very brief overall review here, we can see we bought 3 shares each at different occasions. Let's say the first price was $100 a share, and then just like the current market, the bear market started to kick in and went down to $90 a share, and then effectively went down to 85. So if you bought at each of those entry points, your overall average cost would be $91.66 as opposed to $100 if you bought them all 3 at once. Now again, this mightn't seem much of a difference, probably about $8.40 or so. So again, over time, once you consistently dollar cost average down, you'll be making a lot more profits once to go back to the kind of overall normal price of about the $100 mark here. Now again, this is a very simplistic view here. The markets could continue to drop. Now that's the importance of not putting all your capital in at once if your stocks are down. You need to drip feed it in, which we'll see in my own scenario today. We'll be investing a few €100 instead of throwing in thousands at once, because again, the markets are completely volatile and they can easily go down to, let's say, $70, $60, etc. So at that stage, we would continually dip in or drip feed in capital to get our overall average cost down. So once over the next few years, once there is a bull market come back on the horizon, we will then be making more of a profit because our overall average cost is down. Now again, on the flip side, the markets could recover and it could go up to, let's say, $110, $120, etc. And in that case, I don't buy any more because patience is key. And again, markets are cyclical. They have to go up as well as down. So at that stage, I would be loading up on cash for when the next inevitable bear market would continue. So that's kind of a very simplistic overview of what dollar cost averaging is. Now let's have a look at my portfolios. So now firstly, let's look at Trading212, which is my dividend portfolio consisting of 50 stocks across all different sectors. Now there's many reasons why I want to have 50, but we'll kind of see the importance in a few seconds when we have a look at the different sectors in terms of performance. Now at the moment we're down about 0.7% or just under €5, again, which is absolutely nothing, I know, because our account value is so small. But again, this is a great opportunity to dollar cost average in a lot of these funds because a lot of them are actually in the red, which we'll have a look at in a few seconds. And today I'll be investing a further €80 into this fund, which again might seem a whole lot of money, but again, over time, consistently adding in and dollar cost averaging will definitely pay off in dividend. So as mentioned a few seconds ago, it's very important to diversify across different sectors as a long-term investor. And we can really see here how this plays effect because different sectors react differently to different market conditions. For example, here on screen, we can see that my energy pie, although it's only €50 at the moment, is up over 11% in comparison, let's say, my materials pie, which is down 5.59%. So again, we'll see in a few seconds how different and drastic the differences are between some of these 50 stocks. For example, some are up about 15%, whereas others are actually probably down 15%. So again, the ones that are in the green, as discussed earlier, I won't be touching. I'll leave them alone until they eventually do drop. And the ones that are currently in the red, I'll definitely be taking advantage here, the dollar cost average. Now, I usually don't like the dollar cost average unless it goes down over 3%. But there's numerous examples throughout this 50 stock portfolio that are below 3% at the moment, which actually is very good news as a long-term investor. So as we have over 50 stocks here, I'm not going to go through each because we'll be here all day, but I'll just use an example of where I'll be dollar cost averaging today. For example, in my financial pie, we have 5 stocks here overall, 2 are currently in the green, but we can see here straight off the bat, 2 are really in the red in terms of JPMorgan and Chase down 9.5%, and Goldman Sachs down 11.8%. Now thankfully, because we have tiny amounts of capital invested at the moment, it's going to be very, very easy to dollar cost average here. So that's probably the main reason if you're wondering why I'm happy that my portfolio is in the red, because we have tiny amounts of capital. But again, down the line, if we had, let's say, 100,000 invested and we had a lot in the red, I wouldn't be too happy then. But because this is a long-term approach, this is actually brilliant news because we're effectively getting in at a much cheaper price. So again, we can even see here 11.8, we'll be getting that discounted off our average price when we're buying in next. So again, that's just an example of where I'm buying today. Now in future videos, we'll kind of go through my portfolios in more detail. But again, because we have a few other portfolios to get through today, that's kind of my approach. For now, I'm going to put 80 euro in today, and I'll probably spread it across, again, only about 10 euro or so into 8 of the worst effective shares, which again mightn't seem a lot of capital, but over time, consistently doing so will definitely pay off. Now, the first portfolio I was looking at last night when going over all of these portfolios was my growth portfolio on Etoro, which we started just after Christmas. And again, it was pretty much a bloodbath when we actually look here. We have 10 stocks overall, all very much so in the red. For example, the top one, Amazon, is down 12%. We now have the likes of more double-figure digits here in terms of Tesla, down 10%. And we have some Apple and Google as well, down over 8% each, etc. So again, it's not for pretty sight here, but again, you need to remember as a long-term investor, this is great news, especially when you have tiny amounts of capital invested. For example, overall, we only have about $160 invested at the moment. Now, just like my dividend portfolio, I will be putting in a further 80 euro, which is about $90 or so in here. So we have about $100 to add in later on today once I deposit a capital. So again, this is actually great news. And again, also we have 10 stocks overall. I was going to add 2 ETFs in the form of the ISO's Global Clean Energy ETF and also one of the Cathie Wood's ARK Invest ETFs as well, but we're going to park the 2 of those for now and continue to focus on these 10 stocks. There's a few more below as well, such as Disney and Flutter Entertainment, to name but a few. But again, there's brilliant opportunity here to dollar cost average. Though that's not saying either that these won't go down further, because Amazon could easily drop another 5, 10, 15%. That's the importance of only drip feeding capital in over time. But at the moment, this ETF or this Etoro Grow portfolio is very much so in the red. Overall, we're only down about $13 or $14 overall, which again is peanuts in the overall grand scheme of things. But certainly it's going to be very easy to dollar cost average here, and I'm really looking forward to taking advantage of these discounted prices. Now, just if you wanted to see the bottom 3 here as well that weren't on the prior screen, we have Visa down 4.8%, Flutter down 6%, and Walt Disney is down nearly 12% as well. So I'm really looking forward, as mentioned, to drilling in here and pumping up these overall prices in terms of my investments to get down my overall average cost, effectively net return, giving us a much bigger profit once the markets bounce back. Next up is crypto. Now, again, admittedly, we only have a tiny amount of capital invested at the moment in crypto, all in Bitcoin, about 100 euro or so, which is absolute peanuts, I know. But again, we're going to be investing further here today. Now, as mentioned at the start of the video, I want to invest 200 euro today, and we wanted to put 80 into my dividend, 80 into growth, and I'm going to be putting 40 into crypto. So again, as you can see on screen, I'm sure you're already aware, but crypto overall, and Bitcoin as well in particular, are really having a bit of a bear market and dropping like there's no tomorrow. For example, last month they're down 27.77%, and even for cryptos kind of standard, that is very volatile. It's currently trading about 32,259 euro per coin. So again, because we have tiny amounts of capital invested, this is great news as a long-term investor as well. Now, Bitcoin in particular and crypto overall in general can easily have a tendency to go completely down. It could easily be at 20 grand tomorrow, or it could be at 50. That's just the joys of crypto in general. So again, just like my others, it's probably a boring enough approach, but it works long term, is slowly drip feeding in tiny amounts of capital. Now 40 euro into the overall Bitcoin market is nothing. But again, into my own portfolio, it's bumping up a bit in terms of going from 100 to 140. And then if it drops even further over the coming weeks, just like my other portfolios, we'll be taking advantage there as well. Now, for some strange reason, I can't get into Coinbase, which is my broker of choice here. I can't get into that on my web platform, but I can on my mobile, hence why I'm only just showing you a general Bitcoin screen here. But again, if anyone knows why that is the reason, I'd much appreciate if you could comment below. Now, another portfolio that I've been mulling over as well over the last week or two is an ETF portfolio, which I'm using DeGiro as my broker of choice here. Now, again, this ETF, I'll only have one. It'll be a long-term approach again, and essentially it'll just be the S&P 500. Now, again, in terms of funding this, I have thought of a few ways, but I'm kind of coming to the conclusion that I'm going to use YouTube revenue money here to invest solely in the S&P 500. Because let's say if you made 100 euro from YouTube and just left it in a savings account, it's effectively going down in value. So again, if you pump it into the S&P 500 over time, it should go up in value and kind of counteract inflation. So that's kind of my thinking behind that reason. And again, the S&P 500, you can't really get much safer than that. Surely it won't make you a millionaire overnight, but again, it will slowly kind of grow your overall savings or investments. So that's probably where I'd put my YouTube revenue, into the S&P 500 on DeGiro. And again, kind of over time, I won't be expecting anything drastic in terms of gains, but again, it should be in the profit nonetheless. So that's kind of where we're at the moment. I just want to give a very brief update because I'm kind of aware I haven't made a video in 12 days now because I've been fairly up the walls in terms of stuff outside of investing. But again, that's kind of where we're at with our dividend growth, ETF and crypto portfolios. Now, over the next few weeks, I'm going to have a fairly big update as well in terms of our real estate portfolio. So make sure to stay tuned for that. But for now, over the next week and two, I just want to focus on these portfolios which we just looked at and driving down my overall average cost. And I'll probably be putting in more capital probably next week again, maybe another 200. So again, I'll make a video down the line in terms of how it's performing and how that dollar cost averaging affected my portfolio as we invest that few hundred over the next few days. So thanks very much if you made it this far. I hope you enjoy the rest of your week, and I will see you all in the next video.